All right, welcome everybody to episode 131 of Martinis with Scott, a show about winning momentum in life and in business. Welcome to the bar. Hope you're having a great Thursday afternoon. Yum. What are you drinking today? Are you enjoying your afternoon? Going to take some time off on a spring day? Why do I call this a show about winning momentum in life and in business? I've been arguing with I'm also drinking coffee at the same time, by the way. Finishing that cup of coffee, but the martini time came early. So I have that as well. Why do we call this a show about winning momentum? I've been arguing about the title of this show, not arguing, but having a debate about the title of this show with my marketing people as we look at my personal branding journey and rebranding this podcast or starting a different podcast. What should we call it? Should we call it winning momentum? Should we turn it into pivoting to profit or something along those lines? And here's where I came up with. This is why this show is about winning momentum. It targets the feeling that business owners and entrepreneurs have, people that are assuming the responsibility of life-changing risk to run their business, people that are assuming that responsibility and things aren't going well, they have a feeling of being lost, of being disoriented. I think of them as being in the middle of a forest and it's dark and they don't know which way to go. They just want to get back to their car if they're on a hike or just back home, and they don't even have a direction. It's a feeling, a sensation of being lost. If you run a troubled business, you know what I'm talking about. It's hard to put words to, but for 30 years, I've been working with business owners and entrepreneurs that have had that feeling. And what gets rid of that feeling? What is the turnaround that we focus on? Is it becoming rich and famous? Is it turning from losses on a net income basis to break even and then to profitability? Is that what does it for these people? Is that what attracts, which gets rid of the negativity and the cloud that they're under, and then attracts other resources to the business so that there's positive energy, more capital coming in, people want to work for the business? Well, the answer is no. It's not about an accounting metric or profitability or anything like that. It's about changing direction. It's about waking up every morning and not feeling like you're losing every single day and you don't know what to do to stop it, and to finding a way to wake up in the morning and know that you're going to win today. A micro win. You're gonna, and you don't win every single day. Sometimes you have a bad day. Sometimes you have a day where you're tied, but in general, you have an opportunity to win the game that you've chosen to participate in today. And when you do that, you don't have to be champions at the end. You don't have to win your division at the end, but you need to have an opportunity to win. You need to start winning. And when you do, things become clear. The fog lifts, your attitude changes, you can become positive. You then attract resources, both capital and human resources. Opportunities come to you because your mindset is open to those opportunities. The end game isn't profit. The end game isn't wealth. The end game isn't freedom. The end game is positive momentum, winning momentum. And once you have that, everything else will fall into place. So there's my argument. What do you think? Do you agree with what I'm saying on that? Cheers again, by the way. That's why this show is called Winning Momentum. So as some of you know who have been listening to me, and I know we have a bunch of new subscribers, so I'm going to re-explain some things maybe you've already heard before. But those of you that have been listening to me know that I've been excited about Clubhouse, where a bunch of our new subscribers are coming from, by the way. But Clubhouse, so I do a show with some other panelists, room moderators, they call them. We do one at 6 p.m. Eastern, and I pop on during the week as well. I was on quite a bit yesterday afternoon on the Clubhouse, listening to other people's rooms, throwing in my 2 cents worth, and it's been a great platform. On the Monday afternoon room, I always want to call it a show, but it's a room where you can come in and participate and have a discussion. By the way, for those of you that are looking for invites to Clubhouse, please hit me up in the comments or DM me on Instagram or whatever you want to do. You have to have an Apple iPhone, but I have a bunch of invites I haven't used. So if you have an Apple iPhone and you want to check out this app, let me know. So the discussion in this room Monday evening evolved into, or took a turn into, equity versus debt. You're an entrepreneur, you need to raise some money. What are the different structures that you could look at? How should you think about somebody saying, I will invest money I will invest in your company in equity versus I will invest in your company in debt? Interesting conversation. Clubhouse is not recorded, so I thought I'd cover some of my points here. That question was largely directed towards me. And here's the way you ought to think about it as a business owner, as an entrepreneur growing your business. You need to think about risk and reward. I think that's your metrics, and just evaluate all opportunities for investment coming into your business on a risk reward paradigm. So equity, from your perspective as the business owner, is less risk, less reward. From my perspective as an investor, it's more risk, more reward, right? But from your perspective, it's less risk, less reward. Why is it less risk? You don't have to pay back the equity. Unlike debt, you would have to pay it back. But equity participates and it takes the same level, theoretically, of risk that you do as the owner of common shares of your business. You don't have to pay interest on equity. But debt instrument, you need to pay some interest, creates a cash burden, a fixed cost on cash coming out of the business. And so there's more risk associated with that. You don't have that problem with equity. So again, less risky. The equity ranks the same as you. What does that mean? That means if it all goes wrong and there's a liquidation of the company and you're looking at what I've described on prior episodes as the pecking order of stakeholders. You know, you've got the government up top and the bank, sub-debt holders, preferred shares, common shares. Well, the debt is up here, right? And on the podcast, I'm holding my hand up higher. The debt ranks ahead of the equity. Okay, and if you accept an equity investment, well, that ranks the same as you. So it's a less risky proposition. You don't have to pay it back. There's no interest. And it ranks the same as you if things are going badly. And it doesn't even have to be a dissolution of the company. Let's say your company's worth $2 million and the debt on it is $1.5 million. Well, now the value accruing to the shareholders is only $500,000, right? So, you know, it ranks ahead of you on dissolution, but it also ranks ahead of you just on a sale of the business. If the valuation of the business is not material, is not substantial enough to get past the debt or substantially past the debt enough to start accruing to the shareholders. I'll give you an example of that in a second. So equity is less risky, but there's also less reward. What does that mean? Well, equity is dilutive. What is dilutive? Dilutive means that your ownership goes from what it used to be, let's say 100%, to some different number. Let's say you have a company with 1 million shares. You have 1 million shares in your business and you own 100% of them, and now it's time to bring in $1 million of investment to grow your business to the next level. It's always a risk to take an investment. You know, are you going to put that money to good use? How's that going to work out? You have 1 million shares and you figure your company, you and the investor agree that the company is worth $2 million today. Therefore, your shares are worth $2 per share. 1 million shares, $2 per share is a valuation of $2 million. You want to bring in $1 million equity investment. How many shares do you give that investor at $2 per share? Well, you give them 500,000 shares. 500,000 times $2 a share is $1 million. The investor buys 500,000 shares, not from you, out of treasury. So new shares being issued by the company, that's called treasury. Okay, so now the company has 1.5 million shares outstanding. You used to have 1 million, you owned 100% of them. You still own 1 million shares, but now your investor owns 500,000 shares as well. And that's a total of 1.5 million shares that are now outstanding, still at $2 a share. It means your business is worth $3 million now. Wait, how did that happen, Scott? It used to be worth $2 million. Now it's worth $3 million. Well, yes, that's the difference between pre-money, post-money. It was worth $2 million before the money came in, and now you put $1 million of cash in, so it's the same $2 million business, except it's got $1 million of cash. 2 plus 1 is 3. It's a $3 million valuation for the business, but you own 2/3 of it. You were diluted, right? You were diluted. You used to own 100%. Now you own 66.67%. And you say, yeah, but you still own the million shares and there's still $2 a share. It's still $2 million. So I didn't really lose any value. I just have less of a percentage. Sure, except now it's 3 years down the road. The company's worth $30 million and you're going to sell for $30 million. Well, how much are you putting in your pocket? Well, you're putting 2/3 of that in your pocket, which is $20 million. So now you're worth $20 million instead of 100% of that $30 million, which is $30 million. You were diluted in the ultimate valuation of this business. And that's why diluting yourself, like issuing equity to an investor, ends up in you having less reward if you are successful. Less risk, but less reward if you're successful. Let's do the inverse. Let's talk about debt. What if you are starting a business and you're an entrepreneur, you're at a stage where you want to bring in that same $1 million, but you do it as debt? Well, this is more risky, but there's more reward. Okay, there's a risk-reward paradigm. If I'm the lender to you, for me, it's less risk, okay, but also less reward, because in debt, I have usually a fixed return, which we would call interest, or some sort of coupon that goes along with that debt instrument. So why for you is this debt more risky? Well, or riskier. One reason is you have to pay debt back. So you borrow the $1 million, you need to give the $1 million back. That's a problem, potentially. If you don't have the money, now you're in trouble. You have to pay regular interest on most debt instruments. If your interest rate, if your coupon is say 10%, right, and that gets paid out monthly, so you're paying, or let's say 12%, so you're paying 1% a month. Well, every month, this company that you're using all this cash needs to write a check to pay the interest to the debt holders. If you default, then the debt holders has rights and remedies, and those rights and remedies rank ahead of you, which is the third point as to why debt is more risky. It's because it ranks ahead of you, of the equity holder. We already talked about what happens in dissolution. If the company is insolvent, it's the debt holder gets paid first, and that debt holder can take over your business. Never forget that. Okay, so you need to be really careful on debt instruments. They're much more risky for you as the investor, but you have more reward. Why? Because you didn't dilute yourself. So in the same example, you have 1 million shares in the company, you're valuing them at $2 million a share, you own 100% of them, so you're $2 million of value, and you need $1 million investment. So now you borrow it from a third party. What is the stock worth? The stock is still worth, similar to the equity example, it's still worth $2 a share, but there's still only 1 million shares outstanding, so your stock is worth $2 million. You have $1 million of cash in the bank account, just like you did as if you took equity investment, but to offset that asset, you have a liability, which is $1 million that you owe somebody because you borrowed that money to get that investment. So that kind of cancels itself. You have a debit and a credit, an asset and a liability, both of $1 million, and your stock is still worth $2 million. Remember that your stock in the equity example was worth $3 million. That was your pre-money, post-money conversation. Here it's still worth $2 million, but you got to pay that $1 million back, right? If you wound up the company today, you still got to pay that $1 million back. What if you don't default? What if you do default? What if you can't pay them back? You can't pay your interest? Well, you risk losing your business, and then the equity may not be worth anything. But what if it goes to $30 million and you're able to pay that debt back? If it goes to $30 million and you can pay the $1 million loan back, well, you own 100% of the shares, and so you're worth $30 million. In the example of the equity investment, which was dilutive, you owned 2/3 of that. You were worth $20 million. And you could even say, well, what if you had to pay the debt back So then it was a $30 million sale less $1 million of debt being paid back is $29 million. And you're still worth $29 million versus $2 million. So, sorry, $20 million, 29 versus 20, right? 100% of the shares versus 2/3 of the shares. So debt, from your perspective as a business owner, brings with it more reward and more risk. So I want you to always, when you're considering this issue, if you're looking at raising money into your business, just always think about it on a risk reward from your perspective, and understand that the risk reward for the investor is the opposite. So when you're in negotiations, it's always helpful to understand that way of thinking. Now, what if the equity is really not less risk? So we said it's got high reward from your perspective as a business owner. You're bringing this in. Sorry, it has less reward. It dilutes you. So you bring in this money, you're diluted, but you're doing that because of less risk. You need to ask yourself, is it really less risky to you? Is it really less risky? And you say, well, why wouldn't it be? And the answer is the shareholders agreement. What is the shareholders agreement? So I've invested $1 million into your company. I own 500,000. I own 1/3 of the stock, and you own 2/3 of the stock, right? In the example that we had, but we enter a shareholders agreement. You're the majority shareholder. I'm the minority shareholder. What does the shareholders agreement say? The shareholders agreement. What does the shareholders agreement say? What a shareholders agreement say is it gives me a bunch of rights as a minority shareholder that I otherwise wouldn't have unless I had 51% of the shares. For example, if I wanted to fire you as CEO and I wanted to hire my own CEO and there was no shareholders agreement, I would need 51% of the shares to do that. Well, I would need the directors to do that, and the shareholders appoint the directors. And to have a shareholder vote to change the directors, to change the CEO, I would need 51%. But I do not have 51%. But what I do have, even though I only own 1/3 of the business, is I have a shareholders contract. It's a private contract between the two parties, the majority shareholder, the minority shareholder, or between all the shareholders. You have what's called a USA, a unanimous shareholders agreement, because you could have 40 shareholders in your business, but you want them all on a shareholders agreement. But if it's just you and me, and I'm the minority, what does the shareholders agreement says? Well, it says that you can't do anything without my consent that's of significance to the business. That could be one clause that is in the shareholders agreement, not guaranteed, but it would be a typical clause. So for example, you can't hire and fire major positions without me specifically signing off on who you're hiring or who you're firing. You can't go borrow money without me consenting to you go borrowing money. You can't invest money in new production, in new technologies, in new this and new that as part of your strategic plan. You can't do that without me specifically signing off over a materiality threshold. Was a materiality threshold like I could put in the shareholders agreement, yeah, do whatever you want within budget under, say, $20,000 or $50,000. But if you're going to spend something more than $50,000 or something, I need to specifically sign off on that. It would say that I need to approve annually or quarterly or whatever periodic basis a budget, a business plan, and I have a say in that that's equal to your say or in excess of your say. It would have buy-sell share provisions. What does that mean? It means even though you're the majority shareholder, you can't sell the business without my approval. You can't sell the business to anybody other than to me. You can't sell any of your shares. You can't transfer your shares to your wife and your kids unless it's in the contract or I specifically approve it. The shareholders agreement might say that I get to appoint the majority of the board of directors. It might not say that, but it could say that. It would give me a say over your compensation, or a committee a say over your compensation. I could fire you as CEO of your own company from a minority position because of a shareholders agreement. So when you bring in an equity investor, you almost always will have a shareholders agreement, and you need to understand what that shareholder agreement says. That shareholders agreement says it is very, very important, and it may change that whole risk-reward equation that we're talking about, okay? because the whole premise of equity from your perspective is that it's less risky, but it's dilutive, so it's also less reward. Is it really less risky if that shareholders agreement is difficult for you and it changes that normal equation where the parties would be equal, or the person with 51% would have more power, but suddenly they don't have more power? It is very common, for example, for a VC, a venture capital investor, an angel investor, more of an institutional venture capital, let's say, that owns, say, 20% of the company, but they drive the bus. They drive the bus. They control this company through this contract, through the shareholders agreement, and you need to be aware of that. Similarly, on the debt side, we said, well, that's more risky because you have to pay it back. It ranks ahead of you, but there's more reward for you as the business owner because you haven't diluted yourself. But is there more reward? You need to be careful on the fine details of the debt as well. What if the debt is convertible? What if the debt says, yeah, I've lent you this $1 million, and 3 years from now you need to pay that $1 million back, but at any point, including at 2 years and 364 days into my 3-year term, I can convert my debt to equity at the same $2 per share at current valuation potentially, but even worse for you, at the same $2 per share. And so really it was parked as a debt so that it was a less risky investment for me. That's why I parked it as debt. Yet I get my reward as well, because I could just, if things is going well, I can just convert it into equity and get my upside. If things aren't going well, I could just protect myself by leaving it as debt. So from your perspective, that's a lose-lose, because if you do well, you're diluted because that convertible debt holder converts it to equity and you got diluted. But if you're just bumping along, which is statistically what's going to happen, or you're doing worse, you're doing bad and things aren't going well, then that's not going to convert, and you assume that risk. So you had less reward, more risk. It's just like a lose-lose from your perspective. So you always want to be careful about the debt instrument. What if it's not convertible, but it has kickers? And what price are those kickers at? What is a kicker? A kicker is like, think of it as just a little bonus reward, a bonus return for the debt. So I'll lend you $1 million, you pay me a 10% interest or 12% interest, so it's 1% a month, so I could do it off the top of my head. But in addition to that, I want another 1% per month interest payable in kind, PIK, they call it, payable in kind. In other words, in stock, okay? So now my return has gone up as a debt investor. You started to be diluted, okay? And if you can imagine, there's a million different variations on how this might work. And so always think risk reward, understand the two instruments, the equity investment and the shareholders agreement, the debt, and how the return to the lender is calculated. If it's straight interest, it's easy to understand, but as soon as you start giving equity up, you're starting to dilute yourself. There used to be deals in public markets, probably still is, I just don't pay attention, called death spiral debts. So what would happen is the company's in trouble, a small public company, a large public company, it borrows a bunch of money. Instead of getting it in equity, it takes it in debt. But the coupon, the interest, is actually paid in equity. So it's not paid in cash, or it's some paid in cash, some paid in equity, but there's a significant equity component to it. And so every month or every quarter or every period that is relevant to this debt instrument, there would be a bunch of equity that would be issued, new equity, to the debt holder. Okay, so that would be, if I were the investor, the lender in this case, I would get my equity from this public company, and then what would I do with that equity? Well, I would sell that equity into the market because I want the cash. What happens when you sell equity into the market? You drive the price down. So now I've driven the public company share price down, and now the next month comes along and I need more equity for my interest, but the amount of equity I get is tied to the market price, and the market price went down, so I get more equity. I get more shares because they're worth less than they used to be. And what do I do with my more shares? I sell them into the market and I drive the price down again. and then I get even more shares next month for my interest, and I drive the price down again. And they used to call that, and they probably still do, death spiral financing, because you just end up driving the price of the stock to nothing, which triggers a whole bunch of other problems for the company, and it just kills them. It just kills them. So debt is more risky. Always think about the risk reward, but understand the pieces of the debt, and the terms of the debt, the terms of the equity, the terms of the shareholder agreement, and just it's creative. Get help understanding this, but always beware of the risk reward. That's the way you need to think about it from your perspective and from the investor's perspective. And I thought that was an interesting conversation on Clubhouse, so I thought I would walk through that for you here. And following that, we got into a conversation with a contractor who I believe was from Edmonton, and this had triggered a bunch of things and in his mind. So we asked some questions of the room, of the panel, and specifically he was wondering, well, I think I'm getting to the point in my business where I want to bring in an investor. I think I'm ready to do that. And what were our thoughts on that? What were my thoughts on bringing in this outside investment, and how should he start looking at that? Not attracting the investor, but structuring it, as we just said, debt versus equity. And that conversation evolved into the concept of personal goodwill. And what I said is, and I just want to tackle personal goodwill here, I think we've talked about it a bit on this show before, is I think as an entrepreneur, you need to make a binary choice right away. It's not a permanent choice. You can change your mind 3 to 5 years out, but you need to make a choice as to whether you're building a business that is transferable to a third party, or you're building a business that is not transferable to a third party. Well, why would a business not be transferable to a third party? And when I say transferable, can you sell your business? Do I want to buy your business, right? That's what that means. Well, why wouldn't I want to buy your business? And the answer is because of personal goodwill, because your business is too tied to you. If you're a contractor, if you have the confidence of the marketplace where you are, and you have the brand and it's tied to you personally, if you sell that business to me, who knows nothing about contracting, carpentry, those sorts of things, am I going to be able to make the same amount of money from that business that you're making from that business? And the answer is no. The answer is your business is worth more to you than it is to me, right? Your business is worth more to you than it is to me. And how do you know if you have that problem? Well, you have that problem. Here's a good test. Can you go on holidays for 6 weeks? Can you go on holidays for 8 to 10 weeks? Can you go away, not look at your phone, not answer any calls, not be there to guide this business? Can you go away for that period of time? And if the answer is no, well, then you have a problem. Your business isn't saleable. It's not worth the same amount to me as it is to you, because it's too tied to you. So how do you get away from that? Well, you get away from that by doing a number of things, putting in systems, hiring people that can run the business, right? Professional managers, building brand that's separate from your name. You can think about a lot of things that you could do to make this business sustainable without you being around. And just think about it. Just think about, okay, I'm going to go away for a year. I'm going to go away for 6 months. I'm going to go away for a long period of time. How does this business survive without me here? What are the things that I would need to put in place? So are you going to build a business with transferable value, or are you not? And if you're not, that's okay. What happens when you retire? Well, you're not going to sell your business, or you're going to sell it for way less. Maybe you're just going to wind it down, get rid of the assets, and that's all cool. You had independence, you had a good job, it was better than working for somebody else, and you led a good life as an entrepreneur running your own business, but you haven't built the value, right? And everybody thinks, well, what's my business worth? But they never think about this particular issue. So if we tie this back to investment for this contractor in Edmonton, my view was, if you want to transition your business to have this transferable value, to make your business valuable to me, then maybe it makes sense to bring in an investor, whether that be debt or equity, and think about the risk reward. When you think about that, as long as your use of proceeds, as long as the investment you're bringing in is being used to build the infrastructure of that business to create value for yourself, when you want to sell it. But if you're not building that sort of business, why are you borrowing the money? Why are you taking investment? Because all you're doing is your business has created a good paying job for yourself. And all you're doing now is sharing your paycheck, so to speak, with a third party. So you've just taken it's like a payday loan. You've just taken a loan on your future paycheck, and you're not building value out of it. You're just accelerating. And I'm not saying you're not going to increase your paycheck by making a little bit of investment. But at the end of the day, if it's tied to you, there's a cap on the value of your business, and you need to think about whether you really want to borrow or take a shareholder, take an investor, to split up what in effect is your paycheck. As healthy as that paycheck may be in the future, you want to think long and hard about that. And whenever you're thinking about bringing in an investor, always think structurally. Think about that risk reward paradigm from both of your perspectives. That will help in your negotiation, and it will help protect yourself. All right, I want to do a Novanni Stainless update now for you new subscribers. Give you the quick overview. Novanni Stainless is a stainless steel sink manufacturer in Canada. It sells some to the US, but it's largely Canadian. It's been around 50 plus years. It's in a town called Coldwater, Ontario, which is north of Barrie, Ontario, which in turn is north of Toronto, Ontario, which is the largest city in the country. But when I say north, it's like an hour and a half north of Toronto, Ontario. A small town of 1,000 plus people. I feel like 1,200, but that I might be wrong about that. I didn't look this up before I hit record on this show. Cheers again, by the way. That was good. And so the company was in significant financial distress pre-COVID, got more into trouble during COVID, obviously in March, April, May 2020. Things were very uncertain. Turns out they're an essential supplier. Most of the product is sold through the Home Depots, Lowe's, Rona of the world, and a bunch of smaller chains and plumbing wholesalers and contractors. And so all of that is essential. The rule of thumb for us is if Home Depot's open, we are open. And so we've never really been closed throughout this, but there was great uncertainty. There was great uncertainty in March, April, May 2020. And so the business was struggling. The bank, Bank of Nova Scotia in Canada, what they call in Canada a Schedule A bank, one of the big ones, had called its line of credit, and the receiver was going to be appointed. And when a receiver is appointed, what happens in a company like Novanni? Operations are shut down. All the employees employment arrangements are terminated, so they all go home. The equipment is liquidated, the receivables are collected, the inventory is liquidated. It gets paid to who? It gets paid to the pecking order of stakeholders, the secured priorities. So number one would be the government for withholding taxes and payroll remittances and that sort of stuff. Number two would be the bank, in this case, the Bank of Nova Scotia, right? So they would get paid next. Number three would be other secured creditors. Number four would be unsecured creditors. Number five would be the shareholders in this particular company. So along I come, I'm introduced to the transaction, and I'm able to negotiate with the bank to buy them out. So I don't lend money to the company. I actually pay the bank for their position, and I paid them 50 cents on the dollar because their position in liquidation was worth far less than 100 cents on the dollar, probably even far less than, well, not far less, but somewhat less than 50 cents on the dollar. So I write them a check to now be the bank. So the bank sells their debt and they sell their security to my company, Sinclair Range, and I'm in the business of parachuting into these situations and restructuring and turning around the business with a view of saving jobs. Obviously creating value for me and my investors, should I happen to have any, which I don't on this transaction, but creating value for me and my investors, but also saving a primary mandate of saving jobs in this community. So I buy the bank at 50 cents on the dollar. I then use that to, now I'm the bank, so I can put in the receiver. I can do the liquidation if I want to, but part of my condition for buying the bank is I had an arrangement with the shareholders where I was able to buy the shares. So now we own 100% of the company as well, plus some redundant real estate to spread the risk. So I was able to bring that in, okay? And now we're the bank, and now we're the shareholder, and I've walked you through some of the turnaround plans and the restructuring plans on Novanni. You can go back to prior episodes in probably around fall of 2020, and there'll be a number of briefings on Novanni. I'm not sure which update number we're on right now. So what has materially changed at Novanni? Why am I giving you an update as we head into 2021? And by the way, the company's been profitable, I believe, every month since we've owned the business. All right. So, you know, the power of cash flow, the power of cash flow. The prior owners, who are good guys, worked hard on this business, ran out of cash for whatever reason. I don't want to, point fingers, but they ran out of cash. And when you run out of cash, you run out of options, and you end up losing. And if you have availability of cash is everything. When you're dealing with a troubled situation, when you're dealing with a crisis, you have to have resources, and you're able to get things back on track pretty quickly without even doing a lot of the hard work yet. The hard work is yet to come, but we've been profitable, and in fact, we have been hiring. So we've not only been saving jobs, but we're starting to increase the employment in that community, which is really cool. So I think I briefed my last Novanni update, which was a speech from Novanni, an address that I gave to employees and answered some questions. And speech is a strong word, so let's call it an address. And in that address, I introduced our new plant manager, Cliff, who is an experienced plant manager and has a new approach, a different approach to managing the back operations. This is the manufacturing operations of stainless steel sinks and strainers. And so, we have old equipment, we have a lot of turnover in employees, which often happens when you're in the turnaround business. Troubled companies, they lose some of their good employees, they hire a bunch of new employees, but now you've cut on training, you've cut on safety measures, you've cut on quality potentially, which has not happened at Novanni. Quality's been excellent throughout. And the one beautiful thing about Novanni is that they're great people. And they're great people because they come from small town Ontario, Canada, with a terrific value system. And so that's been the saving grace for this company. But bottom line is we have Cliff on board now, and we have new management in the back, and that's going to be everything to solve the production problems. Is a more experienced, better leader, and better trainer of the human resources, the laborers in the back, in an effort to stop the production problems that we've been having, that Novanni's been having for years. So we've accomplished that, and on my last address, which was recorded for this show, Martinis with Scott, we gave Cliff a few words, so you can go back and see Cliff. So that was a major milestone for us. On December 24th of 2020, we filed in Canada what's called a notice of intent to file a proposal, which is a formal restructuring. It's a way to formally restructure your balance sheet for all these back debts that hadn't been paid in a long time, for years before I showed up. And there was about $2 million on the balance sheet of back debt. And so I've described this to the employees. You can see this on prior shows as well. What is a restructuring? A restructuring is, I owe you some money. I'm going to pay you less than 100 cents on the dollar, and or I'm going to pay you not right now. I'm going to pay you over time. Okay, so that's what a restructuring is. It's how much you're going to pay, which probably isn't 100 cents on the dollar, and how long is it going to take me to pay what we've agreed that I'm going to pay. That's what a restructuring is. Any restructuring, whether it's formal, informal, that's basically what you're negotiating. And that's what we had to do here. I've described it to the employees as, let's say you're laboring in the back and you're making $20 an hour, okay? And let's say you're knocking it out of the park and your supervisor comes along, you do your annual review, you get promoted to a different position, and now you're making $25 an hour. Well, that's great. you've got more income, you can buy more things, you can improve your living situation. It's all good to move from $20 to $25 an hour. Percentage wise, that's a huge raise. But what if you owe the bank $2 million and you're in trouble and you're underwater because of some prior thing that you did and you owe a bunch of money? Well, the extra $5 an hour isn't going to help, right? It's just not going to help because you have a balance sheet problem. So it's great to make more money, but if you owe too much money, well, it didn't help that much. Well, that's what a corporate restructuring is. The turnaround of Novanni, we can make money every month as long as we want, but we have all this old debt. We have contingent liabilities on lawsuits from the past, on a bunch of different things, and it's millions and millions and millions of dollars, and we're never going to earn our way out of that trouble. So we need to do both. We need to make money, not lose money, and we need a clean slate. We need to restructure our affairs so that we're on a solid footing, because if you can't restructure your affairs, why would I put more money into this business if it's just going to them? I didn't borrow money from them. Why would I invest more money in the business to keep it going to pay somebody else, right? This wasn't my problem. The business needs to restructure. And if I don't put more money in to keep the business going, then there won't be any jobs for people. And the mandate here is to save jobs, to fight for jobs, to fight for this business. Something has to give. That's the very definition of insolvency, is you can't do everything you're supposed to do when you're supposed to do it, right? You can't pay everybody what you're supposed to pay them when you're supposed to pay them, right? You can't do it. So something has to give. What has to give needs to be some give and take. I need to put in some money, which I've done. The laborers need to keep doing their job, which they've done. And the creditors, they need to be restructured. They need to participate in this problem as well. And in a restructuring, a formal restructuring where you've gone to a judge, a bankruptcy judge, and you've said, hey, I got a problem. What am I going to do about that? I need your help to corral all these creditors and issue court orders and make it legal. Well, the creditors get a vote. They get to vote on their own affairs. They get to vote whether they accept the company's plan or not. And if they don't accept the company's plan, well, the company is bankrupt and it winds up, and that's the end of it. Everybody loses their job, but the creditors, that was their decision. So it's not like this is forced on them. They get to vote on it. So we had to go through a restructuring, and that deals with a couple $1 million of actual old debt from suppliers that I don't even know who they are. They haven't been paid in a long time. There's a bunch of lawsuits outstanding, so all of this puts a stop to all the lawsuits and the problems that you might be having, that we were having, and that you might be having in your troubled business. There's a contingent claims, a contingent lawsuit. I just heard my earbuds beep, so I'm going to put in the different earbud and hope that the volume picks up and continues well for you. So there's a contingent lawsuit, and all lawsuits are contingent, so there's no judgment on them. But it's there's lawsuits that are real. You bought a service from somebody and you owe them $10,000 and you didn't pay them and they sue you for payment. Well, that's kind of a legit lawsuit. You may fight it, you may have a complaint, it may drag out, but at the end of the day, you bought a service from this person and you ought to be paying them. And then there's just complete bullshit lawsuits, right? So there's a lawsuit at Novanni from a neighbor that had, I don't even know, a $15 million claim on her, something ridiculous for environmental, which is probably the opposite of what the reality is. They probably contaminated Novanni's property, but whatever, doesn't matter. So this gets dragged into it as well. When you do a restructuring, a formal restructuring, it captures all of that stuff, and that stuff is not going to drag your business down and put it into bankruptcy. That's the entire point of the restructuring. And so we went through this formal process. It's been extraordinarily expensive. It's probably going to cost $80,000 to $100,000. When I was younger, in my 20s and early 30s, I remember when a notice of intent process, a restructuring process, maybe cost $15,000, $20,000 out of pocket. Now I'm going to end up with $100,000 probably on this, but all of this past debt has been captured. The company's no longer at risk. The proposal was we'll pay out $200,000 in total. You guys divvy it up pro rata. The creditors voted on it and they accepted it. It was unanimous apart from a $1 claim which went against the vote. And so now the company owes $200,000. That's my further investment. I need to put in another $200,000 in the next 20 odd days, 25 days. And the trustee uses that money to fund out these old creditors. And the balance sheet is clean, and that has been a success. And it was in the creditors' own choice. They voted for this. And Novanni, this is a major milestone for Novanni. It cleans up our balance sheet, so now we're profitable and we're financially healthy. We have no material debt other than me at this point. And one small other secured creditor who's a pain in the butt who I need to deal with next. But you know, the risk is really going away. So that was a major milestone. I wanted to brief you all on that because I think I've talked about this before, but we just received court approval last Thursday. I was in, many of you longtime or recent listeners of Martinis with Scott know that I was in court all last week, and so I missed a bunch of episodes. It wasn't just for Novanni, it was on other files as well, but that was one of our successes from last week. I also mentioned that we received some redundant real estate, redundant being not used, just raw land off to the side as part of this transaction to mitigate our risk. Well, we sold that. We listed it and sold it. It closed yesterday. And that brought in a bunch of excess money, under 7 figures, but high 6 figures. And that money's not immediately available. It's tied up in an escrow, but it'll be available soon. And so that is a way for me to mitigate the purchase price, the money that I paid for the bank, and parks a bunch of money on the side, which will be available to plow into operations should we need that, to reduce my risk should I want to do that, or to invest in capital equipment to upgrade our facility, which I think would be really cool. And on that note, what I really wanted to talk about on Novanni today was a strategic planning session. So I was there last week, I guess. Time is all merged together. I was there last week, and in between court sessions, I was able to hold a quick strategic planning session. I wanted to wait until Cliff had been on a few weeks or a month, so we had a handle of his plant. And so it was me and the general manager, Frank, Cliff, the plant manager, and Natalie from my office, an analyst associate on this particular file. And we have a couple of VPs, associates on the investment banking, corporate finance side at Sinclair Range. Anyways, Natalie is relatively new to us and is a really strong accountant. And so it was the 4 of us. And it was intended, the way I set this up, the reason I want to raise this for you is not only for an update on Novanni, because I've been taking you on the turnaround journey, but the way to affect change in any business, if you want to make a bunch more money in your business, is to step away from this whole budgeting process, which is a complete waste of time and is manipulated to make people feel better and doesn't accomplish much, and instead to brainstorm to big gold objectives, shiny objectives off in the future, and ask yourself what you need to get there. For example, at Roofers World, which is another turnaround journey I've taken you on, although that's been so well, it's gone so well, we haven't talked about it much on this show. But my strategic planning session with them this year was, okay, what if we had to increase revenue 50 times because we're profitable, we're doing well, but we're still a really small business? How would that look? What would happen? And I'm not trying to hold them accountable to increasing their revenue 50 times. I'm trying to create the thought process. What would it look like? This is where we want to be. What would that look like? And it forces discussions about new product lines, new distribution channels, new markets, right? That sort of stuff. And then you can start narrowing it down. Well, the same thing at Novanni. And the problem with manufacturing people is they're very budget oriented. That's the world that they come from. So I said, look, this is not a budget. This is broad goals. What do we need to do to get from here to there? So consider it brainstorming. And the end result of this will be, we will set our agenda, the things that I want to focus on and that I'm going to hold you accountable for 2021. And when I say hold you accountable, I don't mean the specific outcome from this, but are we making progress on the items that we said we need to make progress on in 2021? And so we had it on the whiteboard, and this was a 2-hour session. And for me, I think for everybody, it's an amazing definition of where we want to go in 2021. So I started with fill rates. Fill rates, 100%. What is a fill rate? The fill rate is if Home Depot gives us an order, if Rona gives us an order, if a custom, if a plumbing contractor or a builder someone is making a multi-unit residential building or some industrial complex, and they have custom needs for sink, and our policy is we'll ship this in X period of time, then 100% of the time we shipped it in that time frame. It's either yes or no. Either we did or we didn't, right? And so fill rates are always tricky, but when you're a troubled company and you have a bunch of back orders, your fill rates are not as good as they ought to be. Retailers like Home Depot often evaluate you based on fill rates. It's the most important thing in a turnaround if you're selling to that community, because your scorecard with that retailer goes up. They start buying more from you. They start positioning their products better. They have a better attitude. They start talking to you about where that line's going to go in 2 to 3 years out. It's just a huge, huge change in everything to do with your customer base if your fill rates go up. And I've told you on this show before a story about a turnaround I did in the food industry where I walked in and we were about a 34% fill rate, and I targeted 100%, and we got to 96, 97% in 1 year. Margins went up, revenue went way up, customers were happy, and we became profitable. And that was a focus on fill rates and the things that we needed to do to get the fill rates up. And by the way, if I set a target, here's the whole point about budgeting. If I set a target of 100% fill rate, and I only move from 34% to 96% or 97%, is that a failure? Is that a failure? I mean, I know the whole business turned around, we saved jobs, we're making money, our revenue's gone up, our customers are happy, but I didn't get to 100%, so I failed, right? Well, no, that's a budgetary mentality. If I said, okay, we're at 34%, what's reasonable for this fiscal year? This is not Novanni, by the way, this is the food company I'm referring to. Then the management team is going to say, yeah, well, we need to be realistic. We need to be able to meet budget. We'll go from 34 to 50% or 34 to 60%. We can't get to 100%. We can't get to 90%. But if you force them to focus on perfection, why are we planning to fail, right? If we focus on perfection, then you can move mountains. But as a leader, what you need to do is not go back to people and accuse them of not hitting the target, which was completely artificial. It was intended to be the big shiny lighthouse that you're heading towards, not the actual measurement on which, the metric on which they're going to be measured and their performance review is going to be tied to. So in Novanni, 100% fill rate. We talked about how to define fill rates, how to track fill rates, how to achieve that 100%. And what came out of that conversation? Well, we need to deal with raw material shortages, okay? Because we have chronic raw material shortages. Our supply chain has issues. We don't build enough. We can't get stuff quick enough. And this is part of, it's going to solve part of itself because of the restructuring. Restructuring gets part of the bad debt. Now we'll start building up our credit. It's not a capital issue. We have the money issue. There's container problems out of China. There's a million problems that go into this. And the bottom line is we need better relationships with our suppliers, and we need to build up and hold some raw material inventories to get over this issue. So there was conclusion number one. For 100% fill rates, we need accurate scheduling. So in the morning, when the schedule comes out of the front office and it goes back to Cliff, whose sole job is to produce to the schedule that he was handed. That's 100% attainment. Produce to the schedule that he was handed. And in Novanni, we've learned many times before through the listening tour where I'm out talking to employees and the people in the back, and what they're saying is, yeah, the schedule we get from the office, we treat it like a wish list. We couldn't produce it if we wanted to because we don't have the raw materials. because we've got breakdowns, we've got this, that, and the other thing. And by the way, I'm going to prioritize this customer over that customer. Like I want to meet my Home Depot, and so I'm not going to do these custom orders or what have you, right? So we need to be able to produce the schedule, and for that, the schedule has to be accurate. And for that, the ERP system, which is Sage that we use, the accounting system, the back office system, it needs to know what the raw materials are on hand. It can't be gibberish, because if the planning system, the computer system, doesn't know the raw materials that you have and how long it takes to build something, then the schedule it spits out is going to be garbage, which is what's been going on for a long time. Even though there's a bunch of manual intervention into that system, it's still a serious problem. So to fix the schedule, we need to fix the database, we need to fix the ERP system. So there's another major project for 2021, is to fix Sage. Third, we need some finished goods on hand. Why are we, about 80%, 90% of our revenue comes from 4 to 7 SKUs, even though we have hundreds and hundreds and hundreds of SKUs. SKUs are, just think of them as products. These are things that we sell, right? So there's some stuff that we say we sell, and we haven't sold any of that in 4 or 5 years, but 4 to 7 of the things that we sell so much, it makes up 80, 90% of our revenue, right? Why are we producing to deliver on those goods as opposed to having 2 weeks of finished good on hand or 4 weeks of finished goods on hand, so that when we get an order from Home Depot, we can just go pick it up. We just go pick it up off the shelf and send it out right away. If you, at Roofers World, if you order a Red Ripper or a ladder mount or one of our product lines at roofersworld.com, they're going to ship it to you this afternoon. If you'll accept shipment this afternoon, they will ship it to you this afternoon. There is no wait time because we have some inventory on hand that has working capital cost to it, obviously, but it's been a major win, and so that's what we need to do at Novanni. Another question I put forward during the strategic planning session was, how do we double our revenue? Okay, it doesn't matter what our revenue is today. How do we double our revenue? Which is, by the way, is where this company used to be years ago at its height, was about double where we are right now. And we came down to, we want to continue to build the brand on social media, the Wesson brand specifically, which is a retail brand, sold through Home Depot and Home Depot competitors. We need to re-engage with plumbing wholesalers across the country where we are not listed. Our inventory is not carried, and so that goes to some of our competitors, but we've just lost touch, and we need to rebuild that distribution channel. And the same with new developers, particularly in the GTA and the Greater Toronto area, but in all the major cities. We're greatly underrepresented when we're talking to these developers in getting the Novanni product spec'd into those developments. And so those were the 3 major initiatives that came out of that discussion. And there's a lot of market share to be grabbed. So if we have any measure of success on those 3 initiatives, I think things are going to improve significantly at the top line for Novanni. My third point that I had was contribution margin. I'm not going to give you the specific numbers, but I've told you before, contribution margin, if you want to make more money in your business, you need to focus on contribution margin, overhead, and then revenue, in that order. Contribution margin, then your fixed costs, your burden, and then your revenue. What is contribution margin? It's your selling price. If I sell my unit for $100 minus your variable costs, my variable costs are, say, $60, so I have a $40 contribution margin, which is a 40% contribution margin. How do we maintain our contribution margin to the target that I set for this business day one? How do we get there and improve that? And the answers that we came up with where we have stopped, this company years ago, because it couldn't afford the cash, stopped having annual commodity contracts, commodity being stainless steel in this business. So we're just on a spot market. We're just running around trying to buy steel whenever we can. And so if we were to enter into annual contracts, there ought to be some significant savings there. And part of your variable cost, part of your contribution margin, the biggest part of that is direct materials. It would be direct materials, direct labor, sales commissions, freight. Those are things that are variable depending on how much you sell. So annual commodity contracts is one initiative. Redundant supply. Cost of everything's going up. Cost of packaging, cost of steel. That's the world that we're in right now. The cost of everything is going up. We've just been through a restructuring, and so suppliers try to take advantage of you. Their prices are going up. If we don't have redundant supply, if I don't have 2 suppliers for everything that I'm trying to buy, what is my negotiating strength? How can I negotiate on that? No company wants to go through the work. It's a lot of work to bring your pricing down, your cost down. But if you don't have redundant supply on your key things, then you have no hope. You have no hope of reducing your costs. And remember, direct materials, supplies, these are all variable costs that affect your contribution margin. What you want to do is make as much as you can on every dollar sold. Review pricing. So that was a third initiative. We should review the pricing because we haven't raised our prices in a long time. Prices that we sell to contractors, pricing that we sell to the Home Depots of the world, and yet price of steel, price of packaging, price of all of our inputs have gone up substantially. So how do you improve contribution margin? You lower your variable costs, or you increase your price, or both, right? I mean, that's the math on it. It's price minus variable costs. The only way to get more margin, to make more money, is to have a higher price or a lower cost, or both. Okay, and the third initiative, so we want to review our pricing. The third initiative is just to track this better. Our accounting is still not very good. This was a problem from when we bought the company, and it's better than it was, but we're still not getting great information. And if you don't have good information, if you can't track things, you can't change them. If you can't track something, you can't change it. You need good information, which leads me to the fourth major point that we talked about at the strategic planning session was HR needs and performance. The performance we didn't really get to, so just HR needs, and we need on the ground accounting manager talent in Coldwater at the plant to help, because what we're doing right now is we've outsourced all of the accounting to my Sinclair Range office in Toronto specifically, which in turn is now virtual because of COVID, and so we don't really have on the ground support at a more senior level. We have, of course, a bunch of great people doing, data input and clerking type responsibilities, but we need more talent on the ground, a more senior level on the ground, if I can put it that way, and also marketing support, because we've got more and more opportunities now that we're turning around, that we're starting to ship way better than we used to, and so we're rebuilding channels, which causes us to need to, have updated brochures, updated website, respond to sales requests. If Rona wants to hold a promotion, we need to provide them materials and respond to what we're going to do. And so we need in-house support that we identified on the HR side. And so that was a strategic planning session. And I'm updating you on this because I promised you to take you on this Novanni turnaround journey. And so I think that's important. But I also think it's just amazing. In 2 hours, literally in 2 hours, with 4 people, myself and Frank and Cliff and Natalie, we came up with what I'm going to focus on for 2021. I'm going to focus on defining and tracking fill rates. I'm going to focus on building up raw material supplies. I'm going to focus on fixing sage. I'm going to focus on having more finished goods on hand for the SKUs that turn quickly, right? That make up the 90% of our revenue. These are the things that I'm going to lead on. I'm going to lead on continuing to build the brand of Wesson to get the presence in the marketplace on the retail side. I'm going to lead on plumbing wholesalers and getting us back into that community and with new developers. So I'm going to rebuild our rep channels with that in focus. I'm going to lead on annual commodity contracts, redundant supply for our key purchases so that we have better negotiating power. We're going to do a pricing review, and we're going to track better accounting and track our contribution margins and our fixed costs way better than we have been. And we've identified, and we're going to hire right away 2 positions to help us accomplish those things: the accounting manager on site and internal marketing support. a 2-hour session, not hung up on budgets, but it has set for me my focuses for 2021, which I think will turn Novanni, it'll just take Novanni to the next level. And we may not see all those results in 21, but it'll set us up for the future. And things continue to go great. By the way, we're still making money in Q1. We're sort of 2 weeks away from the end of Q1 2021. We're probably up 20%. I'm just guessing because I don't have all the numbers in yet, but we're going to be up about 20% over 2020. And Q1 2020 was not terrible. COVID really started to impact April, May, June. So Q2 will be interesting this year when I compare it. We're pretty much dead on to where my financial projections and models said we ought to be. So I'm happy about that. And I see we're 1 minute and 6 minutes on this recording. So I'm going to sign off. And I hope you enjoyed that Novanni Stainless update. Check us out at novannistainless.ca, I believe is the website. Check the notes, it'll be in there. And we will see you next week as well for a drink. And we will also do our daily touch base, which will be live very shortly for that. So hope you enjoyed the show. Please subscribe, give us a thumbs up, leave some comments. You got questions you want me to address in the future, let me know. And that's all for this week. Thank you for listening.